103 million ounces. That is the number you need to hold in your head for the next 20 minutes. 103 million ounces of silver sitting in COMEX registered vaults. The only silver that is actually deliverable against a futures contract, backing 429 million ounces of open interest. I am going to show you exactly what that means, exactly why it matters, and exactly what to watch for over the next 2 weeks. But first, last week I told you to watch the DXY at the 100 level. I said if the dollar index broke below 100, it would remove one of the key headwinds for silver and the physical premium spread in Shanghai would start to widen. The DXY held. It did not break 100. It is actually firmed to around 99.40 as of this morning, so we are right at the edge of that level. The setup I described has not triggered yet. It is still valid. I will tell you later in this video exactly what changes if the dollar does break through. Now, my name is John. I spent 15 years working inside currency and commodity markets before I started making these videos. I have sat in rooms where futures positioning decisions get made. I have watched what happens when retail investors get the wrong information at the wrong time about exactly this kind of structural market signal. That is why this channel exists. Everything I show you today comes from publicly available sources, and I will name every single one as we go. If this kind of calm, data-first breakdown is what you have been looking for, hit the like button right now. It tells me to keep making these. And if you are not subscribed, now is the time, because what we are covering today is part of a bigger picture we are building week by week. Today you are going to understand exactly what the coverage ratio is and why 13.6% is the number that is concentrating professional attention. You are going to understand how COMEX open interest compares to registered inventory in a way that actually makes sense. And you are going to walk away with one specific thing to watch over the next 2 weeks that will tell you whether this resolves quietly or erupts. Let me give you the market context first because it sets up everything else. As of this morning, Friday, March 13th, 2026, silver is sitting at approximately $85.40 per ounce. Earlier this week, it touched $88.38. If you are holding silver, you felt every dollar of that move, and then you felt it come back. Gold is at $5,080 per ounce. Hold that number, because the relationship between those two prices, the gold-silver ratio, is one of the most important signals we are going to look at today. The macro backdrop is not helping non-yielding metals right now. The U.S. 10-year Treasury yield has climbed to 4.26%, hovering near 5-week highs. This morning's PCE price index data, that is the Fed's preferred inflation measure, came in with inflation stuck near 3%, well above the Fed's 2% target. The Federal Reserve is almost universally expected to hold rates steady at its March 18th meeting next Tuesday. Elevated real yields are a persistent headwind for silver and gold. The DXY, that is the U.S. dollar index, has firmed to approximately 99.40, and that matters because silver is priced in dollars, so a stronger dollar creates a direct pricing headwind. Here is what makes this moment unusual. Despite all of that, despite elevated yields, despite a firmer dollar, despite a Fed that is not cutting, gold has held above $5,000. That is telling us something important. The safe haven bid right now is structural, not just momentum. And the Iran conflict risk that has reignited this week is adding an acute geopolitical premium on top of a structural one. Silver pulled back from $88 to $85. That pullback is the headline. What is happening underneath it is the story. And now let me show you what I mean. Drop a comment right now. Are you seeing elevated premiums at your local dealer this week? Or have physical premiums normalized? The comment section here becomes a real-time sentiment tracker, and I read every single one. Here is the core issue. The COMEX silver market operates on a system where futures contracts represent claims on physical metal. When you buy a silver futures contract, you are technically buying a claim on deliverable silver. The deliverable silver, the metal that can actually be extracted from the vault against a contract, is called registered inventory. Now I want you to picture a stadium. Imagine counting every person in the stadium and then panicking because the concession stand only has limited hot dogs. But here is the thing. Not everyone in that stadium is planning to buy a hot dog. Most people will walk out before the final whistle. Most futures traders are not there for physical delivery. They are there for price exposure, for hedging, for speculation. They roll their contracts forward or they close them out in cash. The hot dog stand has always been able to cope because the number of people actually walking up to the counter has historically been manageable. But here is where the COMEX situation gets genuinely interesting right now. That hot dog stand has been getting smaller. rapidly. The CME warehouse report, and these are the figures I pulled directly from the CME's own published data, shows registered COMEX silver inventory has declined to roughly 103 million ounces. That is a 23.1% collapse over the past 30 days. Not 30 months, 30 days. A nearly quarter drop in deliverable inventory in a single month. And it happened quietly. Most of the mainstream coverage completely missed it. Now set that 103 million ounces against the open interest figure on COMEX silver futures, which the CME data shows at approximately 429 million ounces. That gives you a coverage ratio of 13.6%. In plain English, each ounce of registered physical silver is theoretically backing over 7 paper ounces. The historic danger threshold in this market has been considered 15%. We are below it right now today. As you are watching this, I need to be precise here because I want to be honest with you. The coverage ratio does not mean the market is about to break. Most of those 429 million ounces of open interest will never seek delivery. But the coverage ratio is a structural warning signal. Think of it like gravity. Gravity does not tell you the exact day something falls. It tells you the direction of the pressure. If that pressure builds, and if even a small percentage of longs decide they want physical metal rather than a cash settlement, the registered inventory does not have the depth to absorb a delivery surge without significant price repricing. The CME publishes daily volume on COMEX silver, and it regularly exceeds 250 million notional ounces per day. The physical vault simply cannot service that demand if it crystallizes even partially into delivery requests. Stop. Before we go any further, I want to show you something that actually supports the other side of this argument, and I think being honest about it is more valuable to you than just running with the scary number. The bears will point to this and say, look, elevated open interest is normal. Commodity markets routinely operate with open interest that exceeds registered inventory because the system is designed for paper trading, not physical delivery. That is true. It has always been true. The coverage ratio has been low before and the market has not broken. They are not wrong about that. There are also structural features that could absorb pressure. The COMEX has an eligible inventory category that is larger than registered. Eligible silver sits in COMEX vaults but is not yet designated as deliverable. As of the same CME report, eligible inventory adds several 100 million ounces of additional metal that could, in theory, be re-registered to increase the deliverable pool if holders choose to do so. The bears will say that eligible inventory acts as a buffer. The bulls will say that if eligible holders wanted to register their metal, they would have done so already. Both of those positions are defensible. What the bears cannot easily explain away is the speed of this drain. A 23.1% drop in registered inventory in 30 days is not a seasonal adjustment. It is not noise. Something is pulling physical silver out of the COMEX registered category at an accelerating pace, and that pace has coincided with, and this is the connection that matters, a significant physical premium emerging in the Shanghai market. If you know someone who has been watching silver this week and trying to make sense of the moves, share this video with them right now. This breakdown took time to put together, and the people who need it most are probably not searching for it. Let me bring in the Shanghai data because it adds a layer that the domestic US picture alone does not capture. The Shanghai Gold Exchange has been reflecting a physical premium for silver of approximately $4 to $7 per ounce, above COMEX-derived pricing. That is a spread of roughly 5 to 8% over the COMEX benchmark, and it has been persistent. Now, before you run too far with that, I want to give you the caveat I always give when I cite Chinese premium data. Premiums in Shanghai can reflect local taxes, financing costs, currency controls, and market structure differences, not just pure physical scarcity. So I am not presenting this as smoking gun evidence that China is draining COMEX vaults directly. What I am saying is that the Shanghai premium reflects structural physical demand from Asian industrial buyers, solar panel manufacturers, electronics producers, who cannot substitute a paper futures contract for actual metal. They need the silver. They cannot roll a futures contract. And that underlying demand is persistent because it comes from a real industrial base, not from speculation. The World Gold Council data on central bank gold accumulation adds another layer to the macro picture. These are not traders checking price charts every morning. When a central bank reallocates reserves into gold, and that buying has been consistent across multiple quarters now, that is a multi-year structural decision. It reflects institutional judgment about the long-term function of the dollar-based financial system. That context matters for silver too, because the forces driving gold safe haven buying, fiscal deficits, inflation above target, geopolitical fragmentation, are the same forces that create the monetary case for silver as a store of value alongside its industrial demand profile. The Bank of England reserve data and LBMA vault activity are also worth noting for viewers in the UK. The London Bullion Market Association remains the world's largest gold and silver trading hub, and LBMA vault data has shown consistent physical metal activity that mirrors the tightening picture we see on COMEX. For investors holding silver within a SIPP, the UK equivalent of an IRA, this structural vault tightening is directly relevant to how you think about medium-term positioning. Now I want to talk about the industrial demand side because I think it is the least understood driver in this entire picture, and it is the one that the gold-focused analysis often glosses over. Silver is not like oil where you can watch it burning. It is hidden inside electronics, connectors, solar panels, medical devices. It is everywhere, and it is rarely recycled perfectly because it is dispersed in tiny amounts across massive industries. The Silver Institute, and I want to name them directly, because they publish the most comprehensive supply-demand data in this market, has documented a structural physical deficit in silver for the past several years running. I am not going to give you a precise ounce per megawatt figure for solar demand, because that would be false precision, and you deserve better than that. What the Silver Institute data shows is the direction of demand. Solar panel manufacturing requires physical silver for the conductive paste in photovoltaic cells, and the scale of the global solar build-out in the US, in Europe, in China, and specifically in the UK's North Sea energy transition, means that industrial silver consumption is not a speculative story. It is a documented, ongoing, growing reality. The thrifting argument, the idea that manufacturers will engineer silver out of their processes, is real, and I take it seriously. Manufacturers have reduced silver content per panel over time, but the scale of deployment is growing faster than the thrifting rate. The direction of demand has not reversed. That structural deficit, set against a COMEX-registered inventory that has just dropped 23% in 30 days, is the combination that has serious market observers paying attention right now. All right, let me show you how I am actually thinking about this week using the 3 lanes framework. This is how I separate what is noise from what actually matters. Lane 1 is the paper market: futures, positioning, margins. What the CFTC Commitments of Traders report, published on its Friday schedule, shows us right now is that managed money positioning in silver has been in a period of cleanup. Hedge funds and professional traders have been reducing net long positions. That is actually an important nuance. Lower managed money net longs means less speculative froth in the futures market. It means the people who would normally be the first to stand for delivery are not as crowded into the long side as they were at previous price peaks. That can be read 2 ways. Bearishly, there is less buying pressure from professional money. Or bullishly, when the professional longs are cleaned out and physical demand remains, the conditions for a more durable price move tend to be better. In 15 years watching currency and commodity markets, the times I have seen all 3 lanes align in the same direction, even briefly, have historically been some of the most significant moments in these markets. I am not saying we are there today. I am saying it is worth knowing what to watch for. Lane 2 is the physical market. The CME warehouse data shows registered inventory at approximately 103 million ounces. The 23.1% drain in 30 days is the single most important data point in this video. Physical premiums at the dealer level in the US and at the exchange level in Shanghai are elevated. That is a physical market showing genuine tightness, not a paper market showing momentum. Lane 3 is macro. The DXY at 99.40, the 10-year Treasury at 4.26%, PCE at 3%, the Fed holding next Tuesday. That macro lane is a genuine headwind for silver right now. Not a knockout punch, but a headwind. When the paper lane is showing cleaned up positioning, the physical lane is showing a 23% registered drain and elevated premiums, and the macro lane is providing a dollar headwind. The historical pattern has been that one of 2 things happens. Either the macro headwind fades, rates drop, dollar weakens, and the coiled physical spring releases into a sharp price move. Or the macro headwind intensifies, dollar breaks above 101, Fed turns hawkish, and the physical tightness gets temporarily overwhelmed by paper selling pressure. That is a framework, not a forecast. You decide what to do with it. Here is the one thing I am personally watching this week. One thing: the gold-silver ratio. It sits right now at approximately 59.5 to 1. Gold at 5,080, silver at 85.40. That ratio is already below 60. a level that historically has been associated with periods where silver has begun re-rating relative to gold. The specific threshold I am watching is whether that ratio holds below 60 through the FOMC decision on March 18th. If the Fed statement is hawkish, signals fewer cuts, expresses concern about sticky inflation, the dollar is likely to firm, real yields stay elevated, and that ratio could move back above 60 as silver underperforms gold on the non-yielding metals argument. If the Fed statement is neutral or dovish, acknowledges growth concerns, signals more flexibility, watch for that ratio to compress toward 55. At current gold prices, a ratio of 55 implies silver above $92. At 50, it implies silver above $100. The data release I am watching is the FOMC statement, Wednesday, March 18th, released at 2 p.m. Eastern. That is your date. That is your signal. This is my one call for the week. John, FX Insider, on record. I will be back next video to tell you exactly what happened. No edits, no excuses. That is the only way this works. Now here is where I want to be completely straight with you, because this is where most channels pick a side and run with it. I am not doing that today. Here is what needs to happen for the optimistic picture to develop. Physical delivery requests into the May 2026 COMEX contract accelerate. The coverage ratio breaches 10%. Asian physical premiums widen further as industrial buyers compete for available metal. The FOMC statement on March 18th is neutral or dovish. Dollar softens below 99, real yields ease, and silver reprices sharply toward the $95 to $105 range. That is the bull case. It is not a fantasy. Every component of it is a plausible continuation of the current setup. Now here is what needs to happen for the cautious picture instead. The DXY firms above 101. The Fed statement is hawkish and signals it is in no hurry to cut. Real yields stay elevated or rise further. Eligible COMEX inventory gets re-registered to ease the coverage ratio. The Iran situation de-escalates over the weekend, removing the geopolitical premium from the metals complex, and silver retraces toward the $78 to $80 support level. That is a real scenario too. Oil prices are elevated right now. If there is a geopolitical de-escalation headline over this weekend, do not be surprised to see silver give back ground Monday morning. Weekend gap risk is elevated. Both scenarios are genuinely possible right now. Your job is not to pick one and emotionally commit to it. Your job is to watch which conditions are actually developing in real time. The market will tell you. You just have to be watching. Before we close, the disclaimer you need to hear, and I mean it. Everything in this video is educational content based on publicly available information. Currency Insider does not provide financial advice, investment advice, tax advice, or legal advice. Nothing here should be construed as a recommendation to buy, sell, or hold any asset. Past market behavior is not a guarantee of future results. Always consult a qualified financial professional before making investment decisions. Before I go, if you got value from this today, the like button takes 1 second, and it genuinely helps this channel reach people who are trying to navigate these markets without all the noise. Hit it now. I want to ask you 2 things, and I genuinely want your answers, not just a thumbs up. First, are you currently holding silver at these levels, or have you been waiting for a pullback before adding exposure? Drop your actual position in the comments. Second, given everything in this video, does the 13.6% coverage ratio change how you think about the risk-reward on physical silver versus silver ETFs? That distinction matters, and I want to know where your head is at. Drop both answers below. The comment section here becomes a real-time sentiment tracker, and I read every single one. Subscribe because next week we are going directly into the FOMC decision. I will show you exactly how to read a Fed statement for its implications on real yields, and what that means for your metals positioning. That is a skill worth having. And if someone in your life is watching their stack right now and feeling confused about what is happening, share this with them. That is the whole point of this channel. This is Currency Insider. Know the market. Protect your currency.